Good afternoon. Good afternoon. We are back. How y'all doing today? Antoine Smalls, Financial Blueprint, man. So happy that I have another day with you guys today as we continue this stock market live today and moving forward. Every week we do a stock market live every week as we pour into you guys when it comes to the stock market, and we continue to push forward, man. Right on this channel. So today we got a packed um, show today. We are going to go over a bunch of different things when it comes to the stock market, investing in stocks, and how we need to move forward into this new quarter, which is the fourth quarter of this year, right? The big thing right now is, as we know, right now we are going through a government shutdown, and there are a bunch of people that are, furloughed from their jobs. A lot of uncertainty when it comes to the federal government, military, and things like that, right? And the funding bill between these two sides. But today we are going to talk strictly about stocks, but we're going to start with government shutdown and how the government shutdown affects the stock market, right? So before we get started, understand that the government shutdown and the stock market are not directly correlated with one another. There are variables that play into the government shutdown that can affect stocks, but overall, the stock market is not directly affected by government shutdowns, as well as the basic economy of the United States. They're kind of separate entities in a sense, right? So the sooner we understand those things, the better overall when it comes to investing in the market. So let's get started, man. Again, hit the subscribe button, hit the like button, share this with someone that needs to hear it as we continue to pour into you when it comes to your investing journey. So we're going to get started with government shutdown and how that affects the stock market. And let's get into that right now.
This morning is Dan Niles, founder, portfolio manager at Niles Investment Management. What a morning to have you, Dan. Good to see you.
Good to see you too, Carl.
Sounds like you think this one, shutdown, could last longer than the one in 18.
Yeah, but it really doesn't matter, Carl. You go back and you look at the one in 18, and during the entire tenure of that shutdown, as I wrote about, the S&P was up 10%. So I think everybody knows this is going to get ultimately resolved. I don't think there's anybody who thinks the government's too small. And so I think people are going to go and focus on more important things to some degree, and I hate to put it like that, but they're going to focus on Q2 earnings, or sorry, Q3 earnings that are about to start to get reported soon. They're going to focus on what's going on with the AI trade, and then they're going to focus on the most important, arguably, unfortunately, which is rate cuts, which has been kind of the stimulus, you could argue, since COVID, and if you want to go all the way back, since Lehman. And you're going to get a rate cut on October 29th, and another one probably on December 10th. And that's just going to keep this irrational exuberance alive until the rate cuts stop, at which point we'll have to deal with reality again. But
so what he's saying is that the government shutdown will not impact the stock market in a negative way, right? The history shows that the stock market actually is flat after a government shutdown, and in some cases is actually positive, right? So what investors pay attention to is earnings. So when earnings come out over the next couple of weeks, that's going to be the most important thing moving forward when it comes to the stock market, as well as interest rates with the Fed being lowered in a couple of weeks, right? So as long as the Fed lowers interest rates, continues its cycle to lowering interest rates, as well as earnings come in a positive direction and forecast move in a positive direction for some of these companies, the stock market will continue to move forward regardless of the government shutdown.
right now, enjoy the ride. I think it's going to be great.
But you call it irrational.
Yes. Yeah. I mean, because think about it this way, right? We have a history of this. In the late 1990s, every internet company was going to win. Now, think about where we are today. How many have won in search? You got one. You got Google. How many won in social media? You really only have one. You got Meta. How many's won in e-commerce? You got one. That's Amazon. And you have a bunch of smaller players, obviously. Now, if you look at the AI space, people think everybody's going to win. Everybody's going to be worth $1 trillion. And that's ultimately going to coalesce down to a few players. But in the near term, when you've got rate cuts, when you've got animal spirits, people want to believe. And if you go back to the late 90s, NASDAQ was up 86% in 1999. To start the next year in 2000, the S&P declined 5%. But the NASDAQ was up another 24% in the first, 2 months and change of 2000. So right now, people want to believe. There's no problem with these circular investments that you see happening, or not everybody putting up great numbers in AI. But until people start to deal with that, the market, much like in late 1999 to 2000, I think keeps going higher, fueled by rate cuts.
So, Dan, do you think the rate cuts, the ones we're likely to get, are purely just sweeteners, or are they necessary to keep the economy from buckling a little bit here? And what are the implications of that if we don't, quote, need them?
I don't think you need them, but our job isn't to try to figure out what should be happening. It's to figure out what you think will happen. So the analogy I would draw is I remember being on your program back in 2021 saying, how the heck is the Fed thinking this is transitory? But they did. They didn't raise. And the S&P finished the year up 27%. Now, obviously, 2022 is a different story when they finally figured out maybe the worst inflation in 40 years isn't transitory. And they started to raise in the most aggressive manner possible. So right now, it's hard to argue you need these extra rate cuts when you've got GDP growing at 3%. You've got inflation that's been above target for 4 years. But none of the reality matters, unfortunately, which is the Fed saying this is transitory as well. And so they're looking at the jobs picture, which is obviously you've got negative numbers coming through. Now, also, you don't have immigration and you have people, aging out of the workforce. So you can say, well, how many jobs do we actually need? But if you really have a dual mandate, how do you justify cutting when inflation's nowhere near your target and you're saying it's transitory again, and you really screwed up not that long ago? But that's reality in terms of what might be going on underneath the surface. But what I'm trying to say is in the near term, I don't think any of that matters like in 2021.
And what he's really breaking down is why it's important to not try to say necessarily as an investor what is the right and wrong answer when it comes to the rate cuts per se and Jerome Powell, the Federal Reserve Chair. But if you understand that the Federal Reserve is looking to cut interest rates, then that only then, pushes up the stock market in a positive direction. So as an investor, what we're looking at is, okay, if you're in a rate cutting cycle, then it only benefits us to be invested in the market because stocks will do better in a lower rate environment versus a higher interest rate environment, which we've been in over the last couple of years, right? So the government shutdown is not impacting the stock market in a negative way. Actually, over the last 48 hours, the stock market has been positive even after the government shutdown, right? So we're moving forward. We're going to continue to talk about the government shutdown and stocks, but also to move the road ahead when it comes to the end of this year, the last quarter of the year, fourth quarter of 2025.
Now we're seeing a market that continues to hit highs even as we enter a shutdown. We entered a shutdown yesterday without any clear end to it in sight. Is this a non-event for the market? It may be an event for the economy. We'll talk a bit about that some more, but is this just officially a non-event?
History shows that government shutdowns are indeed a non-event, both for the economy and for the markets. Now, in the short term, there may be some effects on things like maybe a rise in jobless claims, depending on how furloughs are treated, maybe lowering airline traffic, things like that, but very temporary, not things that are going to interrupt the overall trend. And the use of the word trend, Frank, I think is very important here. You know me, I'm a fairly analytical person. I like to use numbers. I don't like to engage in the banal trite sayings like I'm about to say, which is that the trend is your friend in the markets right now.
Which trend, though? Are we talking about the trend of the Fed cutting rates? Are we talking about tech hitting new highs? Is it artificial intelligence? You got to name one trend.
Well, I was going to, my friend. Start off with keep it simple.
You did it. It was trite.
The equity markets, all right? The trend is higher. And you have to think, I mean, now I'll go a little deeper. Let's go into the AI trade. If you're out there and you're saying to yourself, you're going to sell NVIDIA, like really with this amount of momentum behind it? Sure, get behind whatever bear argument you want to make, whether it's DeepSeek or CapEx one day is going to fall up. But really with this momentum going, you're going to sell it. Good luck with that. And I think when I speak to the trend being your friend, what I'm specifically speaking to is that any dip in the markets is highly likely to be bought. Now, of course, the markets can go down and probably will sometime this month. But consider that something like 25% of professional managers are beating their benchmark this year. So
let's look at this chart. And I wanted to take a second, right? Because if you pay attention to this line, right, and that dipped down to the high 160s, low 170s. I bought an NVIDIA call going out to 2027, $200 call around this 170 mark. And I'm up over 70%. No, I'm sorry. Came down. I'm up about 50%. And we're talking about a month. And we got until January 2027 to continue to allow that stock price to move up and the gains to continue, right? So when he's saying follow the trend, if you pay attention to that line, that trend line, it's clear every time that the NVIDIA dips, you know, and you would argue about $10, $5 to $10, there is a lot of volume and buying of the stock. When it comes to this AI trade and the momentum that AI has currently right now in the market, NVIDIA is the best in the world. So it would be smart to buy not at its high, right? I wouldn't buy at 189, right? I would wait for a small pullback in the stock price. But if you're not buying the best company in the world currently right now in 2025, I'm not sure exactly what you're doing. This is a lot of times I got a text message from someone a couple of days ago and they were like, hey, I'm trying to get into the stock market and I don't know what to buy. And my response was buy the best companies in the world. It's not that hard. You know who the best companies in the world. You know, we're going to get into the 2 or 3 stocks that I say buy right now because of different factors later on in the live. But this is an amazing company currently right now, and the chart shows that it's an escalator moving up. So again, I wouldn't say buy it at 189. We're going to get into the 3 stocks that I would say buy currently at the moment, and some prices to buy them at later on. But this gentleman is telling you, hey, if you currently invested in the market and you look at the trends and the momentum, as well as the Fed cooling, as well as the CapEx spending that's happening between artificial intelligence and some of these companies, NVIDIA is the most important player in that space currently right now that's publicly traded outside of OpenAI when they become public. Oh, you buy NVIDIA currently at the moment.
Far. That means the other 75 are feeling a little bit desperate right now, and they're going to buy any dip. And actually, it's not just AI. So again, Frank, giving you more on this, and not to take anything away from Shannon and Jason, what you may want to say, but if you look at the strong recent rally in pharmaceuticals and healthcare, little give back today, I got it, but still a strong rally. That is people saying, okay, I've got to catch up. Maybe this is a way to do it without having to take the add to the AI that most people already have. I can look at healthcare. I can look at financials, any of a number of areas, meaning the trend really is towards an everything rally here.
All right, Shannon, I want to come to you with kind of dovetailing off what he had to say. If you look at the trend over the last week, short time frame, but over the last week, the S&P equal weight outperforming the market cap weighted S&P. Another area of the market that's hitting all-time high. We talked about tech. Utilities. Now, I think a question for you, is that a broadening or is that simply a trade related to AI where people are seeing the incredible amounts of power needed and utilities are the beneficiary? Or is it a safety trade, a broadening? I mean, interpret this one for us.
So if we're talking specifically about utilities, then Frank, I would say you could look over the last year and there's been significant correlation to the AI trade in terms of how utilities have performed. So if you look at from a year-to-date perspective, utilities are one of the top sectors in terms of performance out of the S&P 500. However, what I think that it's important here is that there's more than just the AI trade as it relates to utilities. So we talk a lot at Neuberger about the potential for a global industrial impulse to help drive growth in 2026. And so if you think about the power demand that exists not just from the AI trade, obviously more pronounced in terms of talking about data centers and the power that's necessary to be able to fuel this AI revolution. But you look at the sort of the backlog of infrastructure improvement that is necessary. You look at the necessity of improving infrastructure, not here just in the United States, but also abroad. And you look at things like the fiscal stimulus that's likely to unfold in Europe. So there is a bit of a push or a tailwind in terms of utilities. I would say I would be hard pressed to find people looking at the broadening trade as an example of people looking to potentially hide out in defensive sectors. That's really not where we've seen that. If you look at something like consumer staples, for instance, the performance just isn't there in terms of wanting to potentially diversify away some of the beta that you're getting in the US large cap names, particularly technology. And so for me, when I look at this, there are certain sectors that are no doubt, potentially kind of the second derivative of what's happening in the AI trade. This broadening out, though, has really encompassed sort of the next trend, if you will, in terms of there's been a lot of CapEx put forth in AI. Where is the next phase of that CapEx? And that's really going to be in sectors outside of technology that are going to start to integrate and implement some of this innovation in their businesses.
Is valuation also an issue when we're looking at the broadening? If you look at technology right now, it's trading at about 31 times forward earnings. The 10-year average is about 21.5. Do you think investors potentially, at least, getting some religion about these valuations, specifically in the tech sector?
I would say it's less about getting religion because honestly, we haven't seen the deceleration in earnings and technology that we maybe anticipated coming into this year, which we thought was going to be a driver of the broadening out. Instead, what I think you're seeing is that, there are opportunities outside of those technology names. I would also point to the earnings picture. If you look at third quarter earnings, Frank, by many accounts, those look fairly conservative. And so if you think about the potential for a continued earnings growth from technology, but also maybe more conservative estimates in some of these other sectors, I think it speaks to getting ahead of some of the positioning. We only have 2 weeks until earnings season kicks off in earnest with the financials. And so kind of positioning ahead of that, that's what I'm looking at in terms of maybe less concern about valuations, more positioning for what could be another strong earnings season in terms of percentage of beats.
Jason Snipe, what moves are you looking to make?
You should not be buying stocks at all-time highs. Okay? Just to put that out there, right? So when you look at a stock and you're looking at its share price and you see the peak of the stock, you should not be buying All right, mic check. Can you hear me? Can you hear me? Can you hear me? All right, so definitely just had some. What the hell is going on? Definitely had some technical difficulties just a minute ago. But we are back now. Let me get back to the video. So just to get you up and running on what we were just talking about is you don't want to buy stocks at an all-time high. You don't want to buy any companies at its all-time high. So if you're trying to choose a stock and you're looking to purchase a company, look at this 52-week high. And if it's currently sitting around that number, you want to kind of wait. There are always pullbacks in stocks. There's always opportunities that come, but you don't want to purchase those companies at those prices, right? So similar to if you were going to the store to buy an item, right? You want to try to get something at a 10, 20, 30, 40% discount if you can. So let's go back to our investors looking for opportunities, and let's get into that video. We are going to discuss healthcare, and we're going to talk about our opportunity stocks for the end of this year going into 2026. All right, so let's talk about that and let's see what they have to say.
Trade based on yesterday's gain.
Yes, the PPH, which was the Vanex Big Cap Pharma. You know, it's been interesting. This space has been under pressure for so long. And the multiples, while they were cheap up here, they just kept getting cheaper and cheaper and cheaper. We know Tim and my Pfizer.
My Pfizer. Pfizer now.
We are all Pfizers now. Yeah. But I think, it's an interesting space. You do have this catalyst in that, yes, there's a deal that it sounds like it would be bad for Pfizer, but the idea of certainty is so much more important. Now, we don't have 100% certainty, but we do have the idea that maybe the target is off the back of this industry. And this is an industry that is not correlated to AI in the way that some other things are. Yeah, we talk about drug discovery and that, but that is really attractive in terms of multiples and has balance sheets that are in great shape for the most part. So there's a lot of things to like here. And to just steal a line from my panelist, I guess.
What? You can use my name unless you've forgotten it.
Timothée, which you make the most money when things go from terrible to just bad. And we've seen a move away from terrible.
Yeah.
Well, I think the positioning in the healthcare sector is so underweight. And so that alone gives a lot of sustainability. We'll get into the fundamentals here. But when I saw this news, it felt like a gift from the White House. This felt like, to me, this was the White House saying, especially understanding the power of the pharma industry behind the scenes, the lobbying power, the ability to really make change, and companies that I think are in a very good position, and in many ways are very much on board with a lot of the policy that this administration is bringing forth. I felt like this was a gift because Medicare as a percentage of revenues for the sector is so low that if you start to play most favored nation with the government and basically say, we'll do whatever you want in terms of negotiating on Medicare, that's a win. When you're Pfizer, who's said $70 billion will spend, when they were already, if you look at their R&D and CapEx spend over the next 4 or 5 years, this is easy for them. This is something that they were going to do anyway. Or if they put a little bit more emphasis into certain subsectors. So I think this is a very important couple days for the sector, because I do think that the headlines that all we do is talk about, and a lot of them are just headlines in terms of also just posturing by HHS and different dynamics. Hopefully some of it's posturing, but we'll see. I think this was an opportunity for big pharma to continue to move. And you brought up the valuations and where a lot of these companies are relative to multi-year, at least EPS relative value to themselves. That's what's really interesting about this. And we can talk more about Pfizer. I mean, that deal last week with Metsera on top of this, that's your turning point in the stock. I'm not sure if this was that bottom for the entire sector, but I think for Pfizer.
Well, coincidentally.
So they're talking about healthcare and opportunities that healthcare is providing currently in the market, right? So if you pay attention to what the new administration has put out, they have been cracking down on drug administration and pharmaceuticals as well as healthcare tremendously since Donald Trump took office, right? So Kennedy is the head, in the presidential, like, you know, healthcare cabinet. He's harping on healthcare costs, drug costs, pharmaceutical costs, and all of the things within the United States that's very expensive, right? And we know healthcare is second to technology when it comes to the United States, when it comes to market cap overall within the U.S. So healthcare is a good opportunity to invest in the market. I would keep it between two companies, Eli Lilly and Stryker. AbbVie is pretty good too. But Eli Lilly is the number one pharmaceutical healthcare company in the United States for sure in the stock market. So do your research. Look at some healthcare options. If it meets your criteria to invest in, that is obviously a great investment moving forward.
There was a mid-stage readout of the long-acting GLP-1 drug that was acquired from Metsera, and that happened yesterday also. So that's another kicker to this, that they're making deals in a good way, in a meaningful way to improve their pipeline, which has been, regardless of whether or not Washington has them in their crosshairs anymore, Pfizer or any other drug company, the patent cliff is still a major issue that remains.
Especially for Merck, without question. And we've talked about it. Welcome back, Tim, by the way. Timotei was away.
Thank you.
Nice to have you guys.
Grazie, mille grazie.
He was in Italy. That's all he knows. Anyway, I mean, I think all this does now is unleash the potential for valuation to get to some semblance of normalcy. Bristol's trading at 8.5 times next year's. Merck probably about the same. You just give them a 12 multiple, which, by the way, is still historically cheap. Bristol Myers very quickly becomes a $72 stock, and all of a sudden Merck looks like a $120 stock. And I don't think that that's far-fetched with the crosshairs being off their back now.
I mean, the rotation here, you have to wonder whether or not this is going to stick in terms of generalists entering the space. But one argument is that people in general, hedge funds, investors, are so overweight technology that they can't be any more overweight technology, and they've got to go someplace else.
Well, you got to ask, though, is there a secular thing going on here? And it doesn't really appear to be, right? So we've had plenty of time to digest some of these different, the drugs, the GLP-1s. We saw what happened there, and we saw it give it all the way back, and not Lilly for that matter. But, like you say, all right, so if Pfizer's getting the game, is it related to the GLP-1? Maybe it's fine. I just don't see why you chase this stuff. I think it's like a win-win sort of deal. I think for the industry, I think it is for consumers, patients, that sort of thing. And it's obviously a win-win for the government because they get some concessions. These are the sorts of things I think make sense from a public-private sort of partnership. We've seen some stuff about some of the investments, and we start asking ourselves, where does that end? You know what I mean? But I would look around and see what are other industries that the government, they could kind of do deals like this. Is there something in the energy department? Who knows? But this seems like something they want to continue. And if you're trying to make the stock market great again, it's actually been pretty great for the last few years. This is not a bad way to juice different sectors and keep the market going higher, because I know we're going to talk about the markets, but the S&P closed at a new all-time high today. And there was a time in the not so distant future where we would have said, a government shutdown at this point with the labor market doing what it's doing, that sort of thing, would not be a good thing. And the market just doesn't care.
So if you go back, let's go back to the stocks and the chart, right? Let's look at right here, right? So big pharma breakouts, right? So Eli Lilly right here is the ticker LLY. By far the best pharmaceutical, healthcare company in the world. As you can see, that stock went crazy. I believe this was yesterday, over 8%. I think it hit over 10% at one point. Went up in $62 per share just in one day, right? So pharmaceuticals, and then you can see Moderna, Merck, Biogen, some of these companies did really well yesterday. Pfizer, as we all know, Pfizer from COVID, Amgen, AbbVie is really good company also. They did really well over the last 24 to 48 hours. The whole strategy is when big hedge funds become overweight in technology, and when technology runs so much over the last 6 to 9 months, what happens is hedge funds will reallocate those funds, right? They'll take profits in a company. Let's say NVIDIA, for example, they'll take some profits. Let's say you're up 200% in NVIDIA in a year. You'll take some profits off the table. You'll then move that money into a value play, which healthcare in this situation, currently in this moment, can be seen in a value standpoint, right? So that's what they're saying. They're saying that there's a possibility that, you know, over the next quarter or two, you could see a continual reallocation of funds away from technology, some of the technology names, some of the big names that have ran significantly over the last 12 months. And you could see them move some of those funds over into pharmaceutical companies, which can then benefit the stock price. So if you are interested in pharmaceutical companies, healthcare companies, definitely take a look at Eli Lilly, take a look at AbbVie, Stryker. And if you want some of the other plays like Pfizer and Moderna and things like that, you can take a look at that. I'm not investing into those companies, but Eli Lilly is a good company. And if you're looking for a pharmaceutical ETF, I believe it was XLV was the pharmaceutical ETF. I am invested into the pharmaceutical ETF. Yep, XLV gives you some investment into the healthcare sector as a whole. So you don't have to always invest in one company. You can invest in the healthcare sector totally, right? So let's move forward. All right. So now we are getting to how do we invest and make money in any market, right? Jim Cramer has a book where he speaks to how to do so. So let's take a look at, that, because it's very important that we understand that regardless if the market is going up, regardless of the market is going down, you can make money in any market. It takes skill, it takes knowledge, understanding, strategy, and all of those things. But regardless if the stock market is going up or the stock market is going down, you can make money in any market. Let's take a look at that.
How to make money in any market. And Jim is here with us now. Congrats on this new work.
Thank you for having me. The show has been unbelievable as always, and I love the discussion at the top about you just got to go with the flow, and I feel that's true.
You feel pretty good. We'll get to the book obviously in 2 seconds.
Sure.
You feel pretty good about stocks heading into Q4?
Yeah, I still do. I'm looking at certain stocks that just can't quit. I mean, the old line names like a Western Digital keeps going. Seagate names that we know for ages, forever. And I just find that what's happened is people have a groove. And they say, listen, I can keep paying up for these and up for these and up for these. And then out of nowhere, healthcare explodes. I mean, and Merck, which has just been a terrible form because of five. Just using these as an analog, is each day it seems like there's something that comes alive with pleasure.
Okay, so with pleasure is how you've talked about the markets and stocks for all of these years. But you do pride yourself on being a teacher and trying to, export your knowledge to help people become better investors. You call this a how-to book. In what sense?
Well, look, I think that what I'm trying to do is democratize things. I want people to be at home to be every bit as good as you guys in terms of facility. All right, you're pure stock pickers, but I want people to understand what you say because it's incredibly valuable. And I want, for instance, I spend a huge amount of time on the PE multiple. What's the multiple? Because I never hear anybody talk about it. I talk about what my mom and my late dad, the mistakes that they made. Like my mom felt that Pepsi, if it was at 100, was twice as expensive as Coca-Cola at 50, and that bothered her. We can't do that. We have to help people. My father always wanted to buy the greatest tip in the world. And he destroyed us on a company called National Video, which was a company that made vacuum tubes right at the height of when solid state came out. So we have to know what we own. We have to like it. And we can't just say, you know what, buy and hold. You have to buy and do homework.
So I 1,000% agree with what Jim Cramer is saying here is you have to understand what you're invested in. You're not just buying companies just to buy companies. You're not, looking for the most popular companies. You're not just blindly putting your money towards a business. This is ownership. So if you want to become a good investor, it's important that you understand the business that you are investing in. Knowledge is everything, right? So if you understand how that business makes money, the revenue that comes in, how much that business makes a profit, what's the profit margin? He talked about PE ratio, which is the price to earnings ratio, how that then plays into how expensive or if the stock is at a value price versus an expensive price. It's so many different things that you have to learn, and it's important that you take some time to understand the market and the businesses as well as how and what ultimately you're invested in. So take a moment. If you are investing in any company right now, if you're an investor in any business, take some time, learn about that business. If you don't already know about it, learn how the earnings impacts it, what's important to the stock price, what is the investors ultimately looking for when it comes to earnings, and how that business will continue to make more money and grow over the long term versus what possibly are the issues in the short term. If we are looking at long-term investing, then we then need to understand the business that we are investing in so that we can properly make decisions, because ultimately this game is about making money ultimately in the end, and you have the same opportunity as anyone else as long as you understand the business that you're investing in, so that you can make money long term.
All these things are about trying to get people to be.
I like to buy and do homework.
Yeah,
I like
say, hey, listen, I'm going to buy a stock and just do great. And I make these mistakes. I bought Bristol Myers and I didn't do enough homework on Bristol Myers.
But you want people to be investors, not traders at their core.
Yeah, I mean, what happens? Look, I think that I was a professional trader for a long time. I just think that a lot of people are at home. They're watching Mad Money when they get home, and they can't compete with people who are just driven and know every piece of data. But they can, on the other hand, find some long-term stocks and compound, and we all think that compounding is terrific.
All right, Jim. First of all, congratulations.
Thank you, Joe.
To your point, Chapter 4, Finding an Edge. Chapter 20, Lesson 2, your stocks will tell you when to sell. As an investor in an environment that you and I both know, market structure has changed dramatically. What's the simplest way that you could do that?
What the simplest way you can tell it is that you take a look at what just goes down and down and down. Then you look at the balance sheet. I actually give. I've never done the multiple stuff, and I've never done the balance sheet stuff. You take a look at the balance sheet. I mean, a lot of people can't read it, but you know what we got? We have chat, we have Perplexity, we have Grok, and you can ask them to take a look at the balance sheet and tell you whether it has too much debt. People have to start doing that. And the people who just say, listen, you just only need to be in index funds, they don't realize that if you want to go look at Bausch Health, thank you for telling me how bad Bausch Health was, you can go in and say, is that balance sheet any good? And it'll tell you, no, it's horrendous.
The opportunities that we currently have with technology is like we've never ever seen before. Again, if you're not using artificial intelligence to help you become more efficient, I'm not sure what time you're living in. It's not about you necessarily being the smartest person in the room for you to know everything that you need to know. You need to know how to use the tools at your disposal to be as efficient and know all of the information as much as possible. Artificial intelligence can help you do everything. Jim basically just said that, hey, you might not necessarily know it yourself, but you can actually put in ChatGPT, Perplexity, and some of these other Grok, some of these other platforms, these applications, these AI applications, put a document in there, right? And ask them, prompt them, and basically ask them to give you all the information. Not just how much stock will go up, but also what's the drawdown for the stock historically, right? And then what are some of the negatives that could possibly hurt the stock and hurt the business as a whole? There's so many different ways that you can get information using artificial intelligence. And in this time, I made trades last week using AI that I'm currently up over 50% in. And the only thing I did was ask AI, based on X, Y, and Z and the current share price of the company, looking over a 1 year out span in 2027, what is the estimated share price in 2027 versus currently? And ultimately, how can I make 100, 200, 300% return on an option trade? And it gave me all the information. It gave me everything. It gave me my risk to reward possibilities. It gave me what my less conservative risk, opportunity was at this strike price versus this strike price going out to January 2027. It gave me all the information I needed to make a fundamental decision based on the information. That current trade is at 44% profit, over $1,100, because I utilized AI. I already knew what I was going to do. I knew what I wanted to do, but I wanted AI to give me more information to justify and make sure that I was making the right decision. You can use AI to help you in every aspect of your life, and I encourage you to do so.
But the other thing that you focused on historically, as we've known each other, is that if you know more about the company, you're more comfortable owning it and actually buying more to increase your return in turbulent times in the market.
Yes. I remember my father sold boxes and bags for a living. We used to go to the Franklin Mills, this giant retail mall. And we would go on Saturday, and he says, we're going to get in front of Gantos, which Goldman liked at the time. There'll be no customers. We sat there in front of it for 5 hours. No one bought anything. It was one of the greatest shorts I ever had. I mean, that's,
that was the Kramer channel check in the parking lot.
But he said at the end, he said, we got to go in and buy something. This is a horrible day for them.
And let me ask you this. Has your view of what you think the quote unquote right portfolio should look like as you've evolved, as the markets have evolved? We grew up, it's 60-40 was the way people talked about the markets, but things are so different now. Investors have different and greater access to more securities and asset classes than they probably have ever had. How do you think about that?
Okay, I'm really glad you brought that up, because one of the major themes of the book, it's very radical and antithetical, but I think it shouldn't be to everybody here, is that you can own index funds and you can own some individual stocks. If you hear something that you like here and you can research it, you can make that one of what I call your 5-stock portfolio, with one actually can be speculative. Yes, if you want to own an OCLO, be my guest. You can have one of those after it's up 80 points.
Only one?
But yes, on a 5-stock portfolio, but I also want index funds. And look, we look at the Trump funds, these new funds where you'll get $1,000.
Right.
That's all index funds. So maybe you also buy 1 or 2 stocks for a baby, because I've got to tell you, individual stocks, whether it be FANG from 2013 or whether it be NVIDIA, they can change your life. I did a book signing yesterday at Barnes & Noble, and there were a couple people who were moved to tears because they had retired because of NVIDIA.
And Jim, I've seen it firsthand. I'll let you in a second.
So what he's saying is you want to be able to buy stocks as well as ETFs, right? So you can buy a group of stocks in an ETF, right? ETFs are trading funds, which are large funds with millions and billions of dollars within one fund that has a holding account, holding up a whole bunch of stocks. So instead of being really risky on one stock, you can buy a group, right? So you can do that. You can buy individual companies if you want to, support and have ownership within one company. I say that you should own multiple, right? You should have 2 to 3 or 4 companies that you really, really believe in, that you really want to invest in. And then you can have 2 to 3 ETFs that you ultimately want to diversify so that you can have a total stock market ETF like VOO or VTI, or you can have a healthcare ETF like XLV to give you, that healthcare allocation within your portfolio. And then you can have QQQ, which is technology, or you can have SMH, which is all semiconductors. But ultimately, in the end, you can pair individual stocks with ETFs so that you can have kind of like a total allocation of the stock market. And we know that on average, the stock market goes up 8 to 12%. It's a fact. Google it. You can, or ask AI, it can tell you, which is a fact. So it's not risky if you understand what you're investing in, and pairing that with ETFs can ultimately help you because the drawdown is less versus one stock that craters because of something that happens bad within the company. So using the strategies of having 3 to 4 stocks and then maybe 2 to 3 ETFs is beneficial. If you're someone that only want to invest in ETFs because you want to be less risky, and let's say you're investing for your children, that's really beneficial too. There's no wrong answer. It's just more like what strategy you have as an investor, and ultimately, what do you want to do long term?
I've seen it. I've seen people come up to you at various places that we've been and say very similar things. And it's so moving to see the impact that you've had on all of these years through all of these books on the individual investor out there.
A policeman came up to me yesterday and said that he had made $1 million on NVIDIA, and it changed his life. But he has a calling. He's still doing his job. It's not really a job for him. But it's nice when you see a regular person, I mean, someone stop you on the street and say, listen, I made $1 million on NVIDIA. It's very moving for me and for him. Liz?
How do you, in a market like this, I mean, it's called How to Make Money in Any Market. The way you've made money in this market is to be a concentrated investor, right? You talk about diversification in here. How do you tell somebody to stay diversified in a market like this where it's like, if you just owned those 10 stocks, you made a lot of money. If you were diversified, it was worked against you.
It's a trick of diversification, Liz. I say you can only be diversified among growth stocks. I have a list of sectors that I say you can't buy because they're trading stocks. And that after you drop one after another, what you're left with is growth. And I want you to be diversified among growth stocks only, because I don't want more than one decision unless the company's fundamentals deteriorate and then you sell.
I want to give y'all this quote. Diversification is what analysts and people tell you because they just want you to buy a whole bunch of different stocks. Diversification is not the way you make a lot of money. If you pay attention to any great company, any great person, any great business, they are not diversified in what they do. Let me give you an example, right? Jeff Bezos created Amazon. What did Amazon sell when they first came out? They sold books, right? Did they sell anything else? No, they sold books online. That is how they made themselves into being what Amazon currently is today. They then expanded into being an e-commerce giant to who they are now, but they made all of their money on one item that they sold. They became great at one thing, right? If you move it into Apple, what did Apple become great at? The iPhone. That is how Apple became Apple. They became an amazing company based on one product. Then they expanded it to multiple products after they became great at the one product. We can keep going. Jerry Jones, Dallas Cowboys owner. If you know Jerry Jones, he made all of his money on what? Oil. He made his billions in oil. He then went and bought the Dallas Cowboys. Diversification is not for rich people. Let's just make this honestly true. And I'm going to quote Warren Buffett because we're talking about someone that actually knows what he's talking about. So Warren Buffett, most famous quote on diversification, says this specifically: diversification is protection against ignorance. Diversification is protection against ignorance. We know ignorance means not knowing. So he's basically saying you're trying to protect your ignorance and not knowing the information. And the reason why you diversify is because you're ignorant and you're trying to protect yourself. He keeps going. He says, it makes little sense if you know what you're doing. One of the greatest investors ever has said that diversification is protection against ignorance. So if we go back to my initial statement about doing the research, knowing the business, knowing the companies that you're invested in, then diversification doesn't make sense. And what I'm not saying is put all your money into one business. What I am saying is you want to be very, very specific about what companies you love and that you're willing to put most of your investment income into. For me, I got got 3 companies that I love. I invest in total of 6. I have 3 that I love, and I got 2 ETFs to pair with that. And we're not including Bitcoin right now because crypto is a different pot, and I invest in crypto also. But when it comes to the stock market, I love 3 companies. So most of my money go in those 3 companies. And then I got 3 others that I like that I put some money into. But ultimately, in the end, I'm not diversified. I'm not looking to be diversified. So understand that when people tell you to diversify your portfolio, understand that they don't understand, nor they do understand, but they're trying to protect themselves and ultimately protect you from ignorance. That's ultimately what Warren Buffett said. So as Jim Cramer is saying, do not diversify within anybody outside of growth companies. He's saying growth companies, you can have multiple growth companies and pour your money into that. But anything outside of growth companies, there is no such thing as diversification, because you're not going to make wealthy money and really magnify your investments if you have your money spread it across so many different businesses. It's mathematically impossible. So if you have, let's say, for example, $5,000, I would argue that you should probably be investing in 3 companies max, and maybe an ETF. And the more you have, the more you can build up your account, the more you should then look to other businesses that you can invest in. But ultimately, if you are having an account that you're trying to build, then you want to take 2 to 3 great companies that you love, and you want to pour your money into those companies and allow those great businesses to continue to make you money every day during the, Monday through Friday, as they continue to do great within the world and ultimately the United States economy.
All right, here it is again. How to make money in any market. It's Jim Cramer. Again, it's number 8.
Thank you, buddy.
Busy man on all these.
Thank you.
Tell our viewers quickly what's coming up for you tonight on Matt.
Okay, well, I've got a company that I think you all know that has just been eviscerated since a great last quarter, J-Bill. And they give you a good sense of how you can move your manufacturing around, maybe able to deal with the tariffs. And plus, I'm dealing with I always like to look at the third quarter when we get to the fourth quarter. And sure enough, the third quarter winners are insanely great today. Maybe there's just don't fight the tape, don't fight the Fed.
Yeah.
I love the show.
That's the way a lot of people are thinking. There's a place for you anytime you want it. Don't be a stranger.
Thank you. And
All right?
remember, when you guys mention ideas, people should now say, I'm going to do my research. I really like that. And there's plenty of ways to research that didn't exist when we got in the business.
Buy and do your homework.
Thank you.
All right, Jimmy. Thank you.
So understand that there are multiple ways that you can find the information for what stocks you want to invest in. There are ways that you can make money in any market, right? No matter if the market is going up, no matter if the market's going down, you can make money in the market regardless of the situation. And then last but not least, diversification don't exist. Not for the people that ultimately make millions of dollars. That's not true. There is a specialty. There is a intentional investment intensity that happens when it comes to millions and millions of dollars being invested in anything that ultimately makes billions of dollars. If you got thousands of dollars and you're trying to make tens of thousands of dollars, or if you got tens of thousands and you're trying to make hundreds of thousands, or vice versa, all the way up to $1 million, all the way up to 10, 20, $100 million, diversification don't exist. You have to choose the one thing that you love and ultimately want to pour yourself into that's going to make you a millionaire. And if you talk to any successful millionaire, they will tell you if it's real estate, if it's stock market, if it's business, if it's oil, commodities, gold, it don't really matter. Ultimately, diversification, that's not a thing. Diversify after you become rich. We don't got time to diversify when we out here struggling and living paycheck to paycheck and trying to get started between investments. No. When we first start in our business, diversification is trash. You want to pour into that one thing that you're great at, that you can do on a daily basis to make you money. And then when you get your wealth and when you get that money and ultimately you can live a lifestyle that you want to live, then you protect your money, then you diversify it amongst different things that can keep your money safe. That's maybe a little bit low risk, and you can then live a lifestyle that you want to live. So moving forward, now we got Tesla. We're going to talk Tesla. Tesla made its delivery report today. Tesla stock price has been on a tear. Let's look at Tesla and go into what Tesla is looking forward in the future, and if we should be looking to invest in Tesla stock.
Weighted Tesla numbers now for Q3. Phil Boscott. Hey, Phil.
Well, those who thought it would be a big quarter because, in part, the expiration of the EV tax credit drawing forward buyers, they were correct. 497,000 vehicles delivered in the third quarter by Tesla. Remember, these are global deliveries, but no doubt, I think over time, as we parse out the different regions and where the strength was, United States will be a big storyline there. 497,000 deliveries, by the way, is a record for any quarter for Tesla. In the quarter, they also produced 447,000 vehicles, and also energy deployment, a record quarter there, 12.5 gigawatt hours. That has been a strength for Tesla. For the year, they're now over 31 gigawatt hours of energy deployment. I think they did 36 last year, so they're clearly going to blow by that in the fourth quarter. But again, deliveries in the third quarter coming in at 497,000 vehicles. Guys, they report their Q2 or Q3 financials, after the bell on Wednesday, the 22nd. That's when we'll hear from Elon Musk. He'll obviously be talking about deliveries, but we know what the story has been for some time with him, and it'll be that day as well when it comes to autonomous AI, robotics. That's the main focus of what is pushing the Tesla shares right now.
Right. Phil, you brought us the Ford numbers yesterday where EVs were up almost 31. Now this. I mean, how are you sort of judging this pull forward given the tax credit expiration?
Well, we knew it would happen. And look, the Model 3 and Model Y both qualified for the federal EV tax credit of $7,500. So it was just a question of how many people wanted to get in on one of these vehicles before the expiration there. And remember, Tesla in August, their U.S. share, I think it was about 38%. It has been coming down, but they still dominate the U.S. market. So we shouldn't be surprised that we see the surge in deliveries of 497,000. Again, yes, that's globally. And yes, they've had challenges in China, certainly a lot of challenges in Europe. But both of those have been stabilizing to a certain extent. And then obviously the surge here in the U.S. Not a surprise that they blew past the expectation of 456. 497, that's why you see the stock up, almost 3.5%, 4%.
And we look at Tesla, they're projected. They were projected to deliver 456,000 vehicles in quarter three. They blew past that estimate. Almost, it's about 39,000 more deliveries than they were estimated. So the stock price, as you can see, went crazy, and it was up to about 475-ish. Yesterday, as you look at the stock price currently right now, it has dropped down to 441. And that's good for Tesla that they've outperformed their Q3 deliveries, right? If you're invested in Tesla, is something that you need to pay attention to. It's not just the United States, but you also need to pay attention to China and how their deliveries or the business as a whole is doing in China, because China has a ton of electric vehicles and they are in really big competition over there, right? So again, going back to understanding how the stock moves and why the stock price moved. And if you just look at that chart right there, if you look back in April, the stock was under 300 a share. It was in the 200s, low 200s, and that has now moved all the way up. It's currently at 440. So if you're investing in Tesla down in that 198, 200, 220 range, you are doing really, really well right now in your shares. And if you possibly bought an option in that April timeframe, you are definitely doing really well when it comes to investing in Tesla. the thing that we need to pay attention to when it comes to Tesla is the auto taxis and the regulation and policies behind the auto taxi. So Tesla's trying to get the auto, taxis up and running to where you can just get into a vehicle. It'll take you where you need to go. You don't need to drive it, and it's automated. That's something that we possibly could be looking to do in the near future. If they can get that business running and operating, Tesla stock will go crazy, right? So if you believe in Tesla specifically, invest in it. I wouldn't invest at these highs right now. I will wait for a pullback. If you pay attention to Tesla stock, it's very volatile. It will come back down. It did go from 470 to 440. Currently, it's at $440 right now. Wait for a pullback. If you could find it coming back down towards about that 360, 370 range. Definitely invest into Tesla if you feel as though it is a great company for your investment portfolio.
But both of those have been stabilizing to a certain extent. And then obviously the surge here in the U.S. Not a surprise that they blew past the expectation of 456, 497. That's why you see the stock up, almost 3.5%, 4%.
I was just going to say, Phil, are you surprised about the move in the stock price? Because to your earlier point, so much of that movement has really been about the future of autonomous robo-taxis.
It's too hard to predict anymore, Courtney, in terms of when you see these delivery numbers. I'm not trying to be facetious here.
Sure.
This is completely a momentum buy into Elon's vision of the future stock. That is 100% what this is about. This does not trade on valuation metrics in terms of the auto industry right now. Do you believe that robotaxi will scale as quickly as many believe? And look, we just had a couple of analysts on who believe that it will scale very quickly. If you buy that, if you buy AI, if you buy autonomous, full self-driving, even separate from robotaxi being a huge revenue driver in the future, well, then you're buying this stock right now. You're not entirely sure how to value it, but you're buying it because you believe that Elon is focused on delivering his vision of the future.
Meantime, Phil, Stellantis is going to open up about 6. There's a broader discussion about consumers willing to look past, I guess, some tariff pressures when it comes to some of these imported cars.
Right. And with Stellantis, those are better than expected numbers. Look, Antonio Filosa has made it very clear. They are pivoting. They're not completely ditching electric vehicles, but they believe that electric extended range vehicles, so essentially you have a generator, a gas-powered generator on board that is constantly charging the electric motors. It allows you to go much further. That's the future. That's what they believe in. Now, they still will have some pure electric vehicles out there, but this is the big pivot that they're doing right now relative to the previous vision that was out there.
Hey, Phil, I was just trying to get up to date on the year-to-date deliveries for Tesla with this new number, 497. It looks like a little over 1.2 million, given the first and second quarters obviously were down. So last year was close to 1.8 million. So I guess we're still talking about a pretty, it would be a pretty good stretch in the fourth quarter to even come close to matching
it'll be
last
huge.
year.
And look, Mike, I think we're going to see a pullback in terms of sales here in the United States. And that's not a reflection on the Model 3 and the Model Y. That's a reflection of the fact that you take away a $7,500 federal EV tax credit, you're going to have fewer people buying EVs. So I wouldn't be surprised if the Q4 numbers are just not as strong as 497. Yeah, I could be wrong. We could see a rebound in China and in Europe, but I don't think based on what we're seeing that I would expect that.
Which is why you need to not buy stocks at 52-week highs at its high, wait for a pullback, and allow that stock to work its way into your investment price range. Not every stock at its high is buyable at that price. Just because you know what stock that you want to invest in doesn't mean that you want to buy it at its current price, right? So understand Tesla is a company that will have these highs and lows, and if you pay attention to its chart, even if you go back to a 5-year chart, you will see Tesla stock will go up a lot and then go down a lot. So be mindful at what price that you buy Tesla at. It's an amazing company. Definitely Elon is back in his bag doing the work that he needs to do. He out of politics, at least for a moment, to where he can focus on getting Tesla back to where it was current, in a few years ago. So moving forward, now we're looking into Q4, right? So we are moving from Q3 into Q4, right? I believe yesterday was the first day of Q4. So now we're going to look at what we need to do moving forward to the end of the year. September was always labeled as one of the worst months to invest in the stock market. This September, we had actually a pretty good September. So now we're in October and we have this government shutdown and we have these moments and times where things are kind of a little iffy right now. But ultimately, in the end, fourth quarter is usually pretty good. November is one of the best months to invest in the market. So if you're looking at buying into stocks currently right now, it is not a bad time to do so, even at its high evaluation that we currently see right now. What we're going to take a look at now is what we need to do in the last quarter of the year and what stocks ultimately do I recommend you look into moving forward. But first, let's look into Q4. Let's look into what the analyst is saying and how they are moving forward in this last quarter of the year and what they're invested in.
ADP's worst print since March of 23. Lisa Cook is staying on the Fed for now. Bitcoin and gold keep rallying, and here's where we begin Q4. We got a 13.5% gain in the S&P 500 year to date. NASDAQ up 17, the Dow up 9, the Russell up 9 as well. Joe Terranova. Actually, you know what? Not Joe Terranova. Liz Thomas. I just felt like switching it up on the fly. Sorry, you're about ready to go.
I feel like I should apologize to you.
He got demoted. All right.
Bad leadoff.
Liz,
Yes,
what should investor mindset be entering this final stretch?
Final stretch of the year, you mean?
Yeah.
So starting the fourth quarter, there's this seasonality. Everybody gets excited. We're going to have a rally into year end. I do think that that is a possibility. I don't know that it's going to start right now and continue unabated. I think that we're at a point after a lot of these all-time highs that the market is due for a pause, and there should be a time of maybe some of the shakeout of these valuations. Many people have been calling for that. Sometimes just the fact of calling for it causes it. But all these warnings that we've gotten about rebalancing at quarter end causing this big move out of equities and into bonds and so on and so forth just never really comes to fruition. So I don't know why we keep worrying about that. The government shutdown, on the other hand, is something that I think markets aren't necessarily going to welcome, but if you look over history, they've actually done pretty well through a lot of the shutdowns. There have been a few here and there that have been bumpy, but on average, returning somewhere between 2 and 3% in the 3 months following a shutdown. So even this isn't necessarily something to be that concerned about.
All right, Joe, earnings season is almost upon us. They're expected to be good again. The Fed is expected to keep cutting interest rates. So I hear everything that Liz said, and it all makes perfect sense about, some of the risk versus the reward. But what I just mentioned, earnings good and Fed rate cuts, and just maybe people chasing, maybe some cash on the sideline coming into the market, it's hard to get in the way of this rally, right? I mean, of this bull market.
Yeah, I think the fourth quarter will be strong for all the reasons that you cite. I think strategically, that's the big question for an investor. And I think when you look at your portfolio, don't be surprised to see a little bit of a turn, a little bit of a rotation here. You're seeing the signs, the early signs of it here, the first day of the fourth quarter. Healthcare coming back into play. Quality up as a factor. Momentum is lagging today. And keep in mind, momentum just does not mean high beta names. Momentum means the Fin 5. I've been talking about them ad nauseum. Well, over the last several days, they're not performing well. Financials not performing well. So I think that little turn within the market is going to unfold here in the fourth quarter. It's probably even going to touch the small cap equity size class, similar to the way that it did last year.
Weiss, what do you make of Bank of America's Flow Show note today? There were record sales of large cap stocks over the last 2 weeks. Sales of single stocks in the last 2 weeks were the third largest of any 2 week period since 2008. It was driven by large caps. Clients sold 9 of 11 sectors led by financials, right? Joe points out a little bit of weakness of late. You had the 6th straight week of outflows, the 4th largest weekly outflow since '08 in financials. Comm services saw the 2nd week of outflows, the 6th largest on record. And sales of energy stocks were the largest since early 22. What do you make of that?
Well, look, I mean, I think you could see it in the charts of some of the companies where they had an amazing run, they peaked, and now people are saying, you know what, we missed a peak before on these names, so maybe we're not going to see a third peak. So let's take some profits. I think that's pretty normal. I don't really know what the correlation is between the flow show numbers and actual market performance. My suspicion is it's actually correlation is higher short term, but I'm going to look at the long term. So I still think that, you know, fortress balance sheets, impregnable business models, they're the ones I still want to own permanent compounders. What I am concerned about, and getting more concerned about it, is that everybody seems to be on the same side of the boat. And when they're on the same side of the boat, that boat wobbles. Sometimes it goes over.
I guess because yesterday I said the same thing on Closing Bell. We had gotten like 40 minutes through the program, and through the 3 panelists at the top and 1 towards the bottom of the program, everybody, no matter what their discipline was like, market's kind of hard to get in front of here. It's set up pretty well into the end of the year.
What I think is important for us and for anyone that, you know, follows me is we're long-term thinkers when it comes to investing. So there's nothing that we're currently looking at right now that we're looking to sell at the moment, right? The market as a whole, the stock market, the US economy, and the GDP is not at a place where we want to sell much of anything. The AI trade is still early in its lifespan. The bubble is not popping anytime soon. We're not looking to sell anything that we believe in long term. And I'm gonna give you 3 names in a second, right? As we move forward into the 3 stocks that I'm looking at currently to end the year to add to. But we're not looking to sell stocks for multiple reasons, right? You want to accumulate more shares, not lose shares. Again, we're talking about the core fundamental investments that we want to invest in. I'm not talking about these outlier situations where you're just trading it for 6 months and you want to take your profits and then move that money into something else. I'm talking strictly about the core 3 to 5 great companies that you want to invest in. We are very, 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 very intentional about continuing to add, not subtract. Right? Continuing to add, not subtract. Great companies. So if you have a core 3, a core 5 that you believe in, wait for those pullbacks, wait for those opportunities to come. And we're going to show a chart. And we're going to show a couple of pullbacks that's happened over the last couple of weeks for a couple companies, and pour into those companies, those great companies, at a lower price. Red is a good thing, not a bad thing. I say this all the time. When I see red in the stock market, I say, ooh, we got discounts. That's the thing. That's the mentality that I have. It's opportunities. It's not necessarily a bad thing. When the fundamentals of a company then shake craters, then you want to get out of that company and move on to a different company. But the businesses that we want to invest in, they moving upward and it ain't stopping anytime soon. So when you see those opportunities, when you see those dips, when you see those little volleys, those volleys that come, pour in, dive in, continue to invest more, and continue to add shares, not subtract shares.
Goldman raising their forecast for global equities the other day, right? But sometimes the crowd's right.
No, I agree, and that's why I'm staying long.
You need to get a bigger boat.
Yeah, we exactly, in a more stable boat, maybe a tri-hull, because to balance it. But that is my concern. My other concern is that as we're going into the quarterly earnings, which will hit in earnest in about 2 weeks, we're going to really hear for the first time the impact of tariffs. And somebody's got to absorb them. We're hearing news that comes out saying, hey, Nike, big on tariffs, huge hit to them. So who's going to pay that? So, and if consumers pay it And well, the other point is that
Nike's up, by the way, almost 6%. So they can have whatever impact they want.
It's from
tariffs.
such a low base. Look at the stocks are
Sure, but it's still up 6%. And many companies, we've long stated that one of the greatest things about this country and these equity markets is we have the best companies in the world and we have the best CEOs in the world. True. And they figure it out. They figure out how to run their businesses through thick and thin. Right. Maybe they pass on a little here. Maybe they absorb a little there. Maybe they tell their distributor, you know what, you're going to have to eat some. They tell their importer, you're going to have to eat a little bit too. And then when you add the pie up, it's not so disruptive to how the whole thing looks and tastes.
And I agree with that completely, but I think it depends upon what your company's end market is. So there are two levels of consumers here, and the gap's widening. And that's not a social comment or anything. It's just factual. So we've got a number where we hear that they're living right now. They've always lived paycheck to paycheck. That's about 60% of consumers. But now it's getting tougher for them because of inflation, because of increases in grocery costs.
I got something for you coming up on that too. Go ahead.
So that is the issue. So if you're playing to them, you know, I think you could be in for some rough sledding.
Okay. So on that note, maybe all of you have seen these consumer finance names. They're in focus because many of them have not performed well. Sort of on the lines of what Weiss is talking about. And he's not the only one talking about it either. The question is it the start of something to be more concerned about? Joe, Capital One's down 5% this week. Affirm is down 15% in a month. Klarna is down 9% this week. Upstart's down 18% in a month. The FT has an article today about subprime auto delinquencies up 9.3% in August. CarMax talked about elevated loan losses in some areas of their loans. That stock is down 27% in a month. BTIG looks at all this today, especially the consumer finance picture, and they ask smoke or fire? Smoke or fire? And what it says potentially about where the consumer is and whether the market is simply too complacent because it's drunk on the idea of good earnings, Fed cuts, and AI overload.
So you mentioned before, maybe we need a bigger boat. Maybe we're ultimately going to just have another boat. And the challenge when I say maybe we're going to have another boat is the boat that we're going to leave is the boat that you're talking about. The names that are levered to that strong economy in an environment where the economy is clearly decelerating. In the new boat, you could put your Mag 7 names, you could put some of the healthcare names, some of the quality names, but the consumer-oriented finance names are reliant on the strength of the economy. And the economy is clearly right now deteriorating. Keep in mind the government shutdown. While everyone would like to say the market's going to overlook it, okay, a protracted government shutdown probably means the unemployment rate with 600,000 government workers approaches 4.7%. That's a problem. Look at the airlines and the way the airlines are trading the last several days. They're trading understanding that leisure travel is going to be more challenged in an environment where the economy is contracting further.
So the breaking news of the morning, the federal government officially shutting.
That's very true what he said about the government shutdown and how a extended government shutdown can be an issue for the economy as a whole and stocks. That's very true. So we're going to move forward into this quarter with the understanding that we need to look at great companies to invest in, continue to take opportunities when they come. When you start to see 5% dips in stocks, when you see 10% dips in stocks, and if you can get to 20%, 30, 40%, which only comes once every year or so, it is very important that you take advantage of those opportunities when they come. And we're going to take a look at 3 companies that I love currently at the moment. And we're going to show them. I'm going to pull them up on the screen. And we're going to take a look at 3 companies. And we're going to talk about them, right? So I am not an investor that looks for the most, penny stocks or companies that I think is under $100 that is, going to make me rich because I invest, 10,000 shares in a company that's $1. I'm not doing that. It's not a smart way to invest your money, right? That to me is gambling. That's not investing. I look for great companies that is one of the best companies in the sector. that has a moat that is not going anywhere anytime soon, that makes so much money and has a really high profit margin, companies that you see on a daily basis, that operates on a daily basis, that's a part of the GDP mover of the United States. That is the companies that we look to invest in Financial Blueprint and ultimately personally within my portfolio. So let's look at the first company. And this company is one that everyone knows. You see them every day. You see them with packages at your door every day. And we are looking at Amazon. So if we look at Amazon's chart, right, Amazon's 52-week high is $242, right? It is currently sitting at $222, and the market is still moving. The market closes in about 10 minutes. Our market closes in about 5 minutes. So currently right now, Amazon's share price is $222. And if you look at the chart, I'm going to pull it closer and like a magnifying glass to where you can see the price movement over the last 3 months, right? So it went up here, it dropped all the way down to 211, and then it moved back up, and you see it on this red line, which is the 200-day moving average. It has been moving upwards. It went up to 238, and then it came back down to hit this, what I would call 400-day moving average, which to me is my entry price when it comes to this stock and how it moves, right? I want to get it at a discount. I want to get it when it's, at a lower price than what it previously was the high at in the past. And I want to see this at a discount. So earlier this week, and about probably a week ago, I think it was last week. I think at the end of last week, it was around this 219, 220. I actually was on a video when I said I bought an Amazon call going out to 2027. I bought Amazon at a call to 2027 expiration date at a strike price at 265. And we are currently moving upwards. It is sitting at 222. And I'm looking to continue to buy more shares, which I have when it came down to this 218, 217 point, which was last week. Right. So Amazon, as we know, is a great company. It is one of the best companies in the United States. It is a company that you spend money in and on a daily basis. We know that they make millions and billions of dollars. They have a really high cash flow. The profit margin of the business is moving upwards. If you know anything about AWS, which is their web services and their artificial intelligence, they're pouring into Amazon Web Services, which you then see at football game at the, what day is that? Thursday night football games. Actually, it's Thursday. So you'll see Amazon, you'll see the Thursday night football game on Amazon Prime. You'll see Amazon Web Services operating within the football game using this technology. AWS is by far one of the best technology plays out there when it comes to software within the technology space and businesses. So if you believe in a company like Amazon at its share price at 222, it is definitely an opportunity to buy it at a price that it is less than its 52-week high. It is at about a 10 to 15% discount currently right now to its all-time high. It is definitely an opportunity to buy Amazon, right? So Amazon is something that I personally bought when it came to shares last week, as well as an option going out, a leap option going out to 2027. I did that last week. I think if you want to buy it now, I think it's still at a great price at 222. Anything above that 230 mark, I'm not touching it. I'm waiting for a pullback again. But if you are looking at Amazon right now, it is definitely a good stock to buy. All right. So that's one. All right. Let's go to number two. Meta, which we all know as Facebook. All right. So let me bring this chart out a little bit. All right. So Meta's 52-week high is 796. All right. If you pay attention to the stock price, it came all the way down to hit this 400-day moving average, which was in April, which was 479. If you bought Meta at this 479 point, Definitely made a lot of money over that time span from April till now. All right. If you're looking at a closer magnifying glass, get a little closer. It again, that 796 level from a price standpoint hit in August. It has come down, hit its 200-day moving average, went a little lower than that 200-day moving average right here. It moved back up above that 75, which is the yellow line. It came back down to hit this 400-day moving average, which is currently 720. And again, when price levels hit my targets, I execute. The goal here in the end is execute on prices that you want to buy a company at. How you determine those prices is up to you. I use moving averages as well as Fibonacci's that can help me understand what prices are good to buy certain companies at. I look at the history of the price movement. I look at PE ratios. I look at if it's cheaper to the S&P 500. It's many different factors that we're looking at ultimately, but when opportunities come, this is one of those opportunities, right? Meta was at 717, I believe, a day or two ago, and I bought a few shares at 719. And then when it came down to hit that 717 mark, I then bought an option to end the year for Meta. So I took a December 2025 option strike price, and I played this 200-day moving average price at 750, and I played a 750 to end the year strike price on Meta, and we see the price is moving up a little bit. It is closed today at 720.27. I am looking at this growth movement up throughout the end of the year, which Meta should be clearly above this 750 mark, probably closer to 800 by the end of the year. And that's what the expectation is for Meta. So I bought more shares at this 717 mark. It has moved to 727. It's good. It's still a good time to buy Meta. If you are interested in Facebook, Meta, whatever you want to call it, we know that the number one social media player in the world is Meta. It's Facebook, it's Instagram. They are running the show. They continue to enforce AI into the platform. Amazing social media. The most users on a daily basis, the most users in the world are on Facebook, are on Instagram on a daily basis. Zuckerberg and Facebook, Meta ultimately is running the show, and they are an amazing company to invest in long term. Buying it at this 700, that 720 level is definitely an opportunity. If it were to pull back anywhere under this 200-day moving average, I would buy anywhere in the 600s for long-term portfolio. Definitely take advantage of Meta. And that is stock number 2 that we are currently looking at for the investment portfolio, as well as options. All right. So the first was Amazon. We moved to Meta. And then my darling, this is the darling of the bunch. It just reached its 52-week high yesterday, I believe. Or was that today? Was that today? I think that might have been the day. NVIDIA. Yep. NVIDIA hit its 52-week high today. All right. 52-week high is 191.05. Amazing company. If you are not investing in NVIDIA, I mean, you're missing out. You're missing out on one of the best companies in the world. You're missing out on a new AI play. You're missing out on our technology growth long term. It is so beneficial to invest in this company long term in your portfolio. So let's go to a 1-year chart, and I want to start here. And if you see down in April, it came down to that 86 level. I remember back in April, I bought NVIDIA at 93. I bought shares at 93, and I bought an option going into 2026. I am currently up in shares over 90%, something like that. 90, we almost at 100%. We close to 100% because I then bought more shares at this level down here at 160 something. But moving into the current levels now, again, opportunity was in early September when it hit 160, 165. That was the next opportunity to buy Nvidia at a discount. So again, when we're talking about buying stocks, we want to identify the stocks that we love. And then we want to look at the price. And we want to, if you technicals is something that can show you the historical price movements of the stock. It can then give you an understanding, a visual understanding of the stock does move up. It does come back a little bit historically. More than likely with the price movement of the market, there will be a pullback or two or three throughout the year for you to pour money into. You don't want to just buy it at any price. You can dollar cost average, which is basically buying every month, buying every 2 weeks, just consistently buying over time. But when you become more understanding of how you should invest, buying at discounted prices is the way to go. You're going to ultimately make the most money if you buy it at a discount versus just buying it just to buy it, right? So we missed out on this opportunity in September, right? We bring this a little closer. Now we're talking about a 1 month view. Every single dip you see here is an opportunity, right? So 169 was the middle of September. It came back down to hit this 200-day moving average, which was 175. So we had another opportunity around 175. And I believe I got into a 200 January 2027 call around this 170 mark. And that call, which I was just talking about with AI, using AI, is currently up 43%. 43%. Can't see it, but my Nvidia call from 170 to where it currently is at 191 with a 200 strike price is up 43%. And that is a expiration of January of 2027. So for the next 12 months, we're going to be making money off of an option call through the next year, or 2027. Right? So great companies. We bought more shares at 165. I would not buy it. This is on the watch list. Obviously, I would not buy it right now at 191. I would wait for a pullback over the next couple weeks. If you see Nvidia coming back down, let's do a 5-day chart. If you see Nvidia coming down to that 180 mark, 185, and you want to get into it, well, probably not 185, that 180 mark, 175. Yeah, I mean, 180 would actually be good. 180 to 170, 175 to 180. I would buy more shares than Nvidia. Right? So we looked at Amazon, we looked at Meta, and ultimately what I would say the best company in the world, which is Nvidia. Right? So 3 companies that we're looking into and continuing to invest in. I implore you guys to continue to do the research, continue to tap into the market. The only way that you're going to be knowledgeable about these things is you got to do the research. You got to read. You got to read. You got to do the research. You got to put yourself in an environment that talks about this topic all the time. And we here on Financial Blueprint. I also do coaching calls and things like that when I try to help people one-on-one to get them in a place where they can understand things from a deeper perspective. But all in all, invest. In this climate right now, with interest rates, with inflation, with the job market, you have to be able to invest money to make you money while not working. That's the goal here. And then look at long term and how you can grow money at a pace that you couldn't do it any other way, right? So I encourage you guys to continue to invest in the stock market. Take some of these stocks that I talked about, look at them personally, dive into the market, learn, continue to tap into the channel. If you want to, get a call with me one-on-one, please reach out to my email, which is in the description, as well as on my channel description and everything. So you can tap in with me personally. I am definitely free when it comes to help people out, learn more about stocks, financial literacy, real estate, all of it, right? So this is what we do here in Financial Blueprint. I love you guys. I appreciate y'all. I'm out. Remember, hit the subscribe button, like the video, and continue to tap in with me long term in this channel, man. I love you guys. I appreciate y'all. I'm out. Financial Blueprint, Antoine Smalls. Peace.